Okay, thank you very much. It's great to be here, and I had a fascinating time thinking about this very important topic and trying to pull together some of the things I learned from Tom and Stephanie and Bob. So, just to set the stage, again, I think we know the frame, but can never do better than put up one of Jim Perturba's tables. We have this problem of increasing longevity, and this is a table from Jim's Ely lecture from a couple of years ago, where he's just showing us the increasing mean age, expected age at death, conditional on reaching age 65, the way that's gone up for men and women. And then he nicely includes the tail risk, which is the 80th percentile of that age, which of course is also rising and getting into the 90s. So we have a serious funding problem for long-term retirement. Now, this hasn't been put up, but this is also a big part of the problem. This is the declining worldwide trend in the long-term safe real interest rate. So these are inflation index government bond yields going back to the mid-90s, so showing us now over the last 20 years. In the late 90s around the world, where there was certainly some spread across countries, the pink line is the US, but you can see in the late 90s that you had TIPS yields between 3.5% and 4%. They briefly got above 4%. Amazing. Now we're at 50 basis points or so. And this trend is not just the result of monetary policy since the global financial crisis. It's a secular downtrend, and it doesn't show any sign of reversing quickly. So we're trying to fund a long retirement with very low safe real rates. Of course, we might take risk, but Bob very eloquently explained the difficulty with this, that the downside may be realized. So it is natural to turn towards housing wealth. And actually, Jim's table from earlier in the morning dominates this one. This is just a summary from a paper I've been doing, but Jim had some very good numbers on housing equity in different parts of the wealth distribution. But all this table does is it shows you that for the average share in total gross assets in the US of the main residents is about 40%. And of course, a lot of that is mortgaged, but in the senior population in particular, they tend to have built up considerable home equity. All right, so we're interested in tapping that wealth. Now, what is the basic concept of reverse mortgages? You've got this housing wealth. It would be a simple thing to downsize or to sell and rent to extract that home equity and be able to spend it, but many older people don't wish to move. So the alternative is to borrow against the accumulated home equity. And that's the reverse mortgage, or HECM, is just a mechanism for doing that. Why is it called a reverse mortgage? Well, instead of the principal declining as the debt is paid back, the principal actually increases, at least as fast as the interest rate, and faster if you have a line of credit that you're taking up gradually. Okay, so it's reverse in the sense that principal is growing rather than declining. You don't need to make any payments before the sale of the home. And of course, the lender has no recourse in the event that the home sale doesn't cover the debt. So the speakers have explained very eloquently why this might be a good idea. I'm going to try to address the question, what is it that's limiting demand and limiting supply in the present environment? And as a discussant, I'm going to have the privilege of offering conjectures without any need to prove them. Okay? So, first of all, on the demand side, why is demand so limited? We do have this HECM program with an FHA role to provide insurance, but the demand is small. Stephanie's slides showed that, and the CFPB a couple of years ago reported a participation rate less than 3% across all eligible households. So this is a tiny market share. Well, one story you might tell, and Stephanie's work gets at this, is that there's other competing products. Homeowners, seniors can use home equity lines of credit or cash out refinancing. And she documents that the HELOCs are preferred by the homeowners who qualify them, higher income, white borrowers particularly. Cash out refinancing seems to be used by less creditworthy homeowners in rising markets. But still, we might expect to see greater equity extraction by older homeowners using all those channels. And again, that's the main lesson from Stephanie's work, is that we need to think about the channels jointly, but we're just not seeing as much equity extraction as you might expect. Well, so I started to think of things. One sort of rather obvious story you might tell is that actually homeowners want to keep that house or that home equity because they have bequest motives, and they want their grown-up children to live in the house or at least in the neighborhood. In which case, this asset is the perfect hedge. It's not risky given their motivation. Of course, I think if you think about contemporary social conditions, it should be attractive even then to use a reverse mortgage to fund a down payment on another local home, since in US society today, adult children often do not live with their parents. So I set that to one side as probably not the main story. But now I'm going to offer some conjectures about things that I do actually believe to be important. So my first conjecture on demand is that retirees retain housing equity, in part at least, because they see it as a vehicle for funding emergency medical and long-term care expenses. It's a natural vehicle for that, partly because it's illiquid, so you're not going to be tempted to get at it until that moment. You're reluctant to move, but if you have a negative health shock, that's going to overcome the reluctance to move and deliver the home equity to you precisely at the moment when you need it. So some supporting evidence on that, there's some work by Makoto Nakajima and Irina Telyakova, which shows they do a cross-country study, and they show that retirees run down both financial and housing wealth faster in countries which have better public funding of healthcare. So that's a clue, I think. John Amarick's in work with Andy Kaplan, who's here today. They survey clients of Vanguard and find that they design these survey questions to elicit what's limiting dissaving among these people, and find that healthcare concerns are very important. The story is also consistent with the fact that HECMs have been taken up more among households that are in income and wealth brackets where Medicaid eligibility becomes important. Since obviously Medicaid is providing an alternative source of coverage for medical and care insurance. Now, the thing about this story is if this is all that's going on, it implies that there should be very strong demand for long-term care insurance. And you should ask, well, why don't people take out the reverse mortgage and use the proceeds to buy long-term care insurance, and then they can still annuitize some of what they took out? So I think this is part of it, but perhaps not everything. Second conjecture is that the retirees are not valuing the embedded put. And this is where Tom Davidoff's work comes in. He's got some pretty compelling evidence that they're not actually using this in the most strategic way. Either they don't understand it, or they may have ethical qualms about ruthlessly extracting, ruthlessly borrowing with an intention immediately to default. And this will lead them to undervalue one of the key features of a HECM. Okay? Now, a related point, my third conjecture, is that retirees find it very hard to know if the product is fairly priced. Okay? There's all these upfront fees, there's an elaborate calculation, there's an embedded put, there's interest rates. I mean, this is pretty hard even for professional economists. Tom has a paper in the RFS that just came out which says, are HECMs really high cost? Okay, well, if professionals are writing papers about whether it is or isn't high cost, it's understandable that retirees may be confused. And I think there's plenty of evidence that people, and particularly older people, mistrust financial institutions that offer hard-to-understand products. A nice example is a paper by Eric Johnson and co-authors, which studied an episode in which a nonprofit lender in Chicago sent letters of pre-qualified refinancing options to their borrowers. In other words, no ambiguity, you qualify, you can cut your rate. The lender is a nonprofit, and still many households wouldn't take it up. And they present some evidence that this is the result of mistrust. People feel that this is too good to be true, there must be a catch, I don't get it, the bank's going to rip me off in some way. Now, if you want to think about formal academic work, you can model this as ambiguity aversion, the idea that if you don't understand the true model of the world, you pick the worst model and assume that model, the worst plausible model, and assume that model is true. In this case, the worst plausible model is this product is a ripoff. I'm not going to touch it. Now, let's turn to the other side, to the supply side. Reverse mortgage lenders appear to be very reluctant to take house price risk. The small private market for this evaporated in the financial crisis, so the FHA is left running the market. And Bob Merton rightly pointed out that this is problematic. He has plans to fix this problem, but I'll offer some complementary thoughts. So 2 conjectures about the limited supply. The first one is we need to recognize that retirees with reverse mortgages only have strong incentives to maintain their homes when they have positive home equity. If there's a housing downturn, you'll have a debt overhang problem. And we know that ordinary mortgage borrowers do cut back on maintenance when they become distressed. Brian Meltzer has a forthcoming JF paper on that. Now, this is even more serious in the reverse mortgage case because lenders can't foreclose. So with a conventional mortgage, you become distressed, you're not maintaining the property, but the bank comes in and takes the house before the house starts to fall down, the Uncle Jesse pictures, okay? So the distress can go on for a long period of time. Also, there's a more general tendency for older homeowners to maintain their houses poorly. So I had a paper where we looked at house prices, and the age of the seller has a negative effect on the price that the house fetches. And we interpreted this as the result of low quality, poor maintenance. So the collateral for reverse mortgages is of unusually poor quality. And again, Tom Davidoff's work relates to this, although he points out that if you control for zip code level prices rather than metro area prices, the effect is diminished. Now, a second issue with supply is that the behavior of retirees, in particular their willingness to default ruthlessly by drawing down the credit line when they're underwater, that behavior is hard to predict. This is an example of the more general phenomenon that if we give people options that they don't know how to manage, all we do is we create a new source of hard to manage risk, like prepayment risk in traditional MBS. So borrowers may not default ruthlessly, but if I were working for a bank and I proposed to my boss that we should lend on the assumption that they will not, I easily might lose my job. The borrowers might turn out to be Livia Soprano, in which case we'd be in trouble. Again, if you want to be formal and do some academic theory, you could model this as ambiguity aversion. So Tom called this, he talked about this problem as sort of a bid-ask spread problem, that the borrowers don't value the default option, but the lenders don't have to price it in. Okay, so then what that does is it kills the market. So let me finish with a few thoughts about the best reverse mortgage market design and how we might be able to get around this. Design proposal 1, I think these mortgages are ideal candidates for arms, not firms. Okay, because firms can be expensive if you don't know how to refinance them. That's hard for all households, but particularly elderly ones. The main problem with ARMs normally is that if interest rates go up, that shocks the budgets of households that are borrowing constrained. But that doesn't apply in this case because interest rates are just rolled into the principal. So these things should, in my view, clearly be ARMs. Secondly, I think these mortgages are ideal candidates for automatic linear adjustment of principal in response to house price indexes as proposed by Bob Schiller and others. Why? Because retirees they're on a downward trajectory of housing consumption. They should wish to lay off house price risk. That's not generally true for younger homeowners who are going to be in houses for long periods of time or may even be buying up later in life. The automatic adjustment of principal will maintain borrowers' incentives to maintain their homes, even in declining markets. And finally, the adjustment of principal automatically will reduce the role of the homeowner put option, which they don't know how to exercise. If homeowners don't really want an option and don't know how to use it, why offer it to them? Why not just do something simpler? Third, I think it's clear that reverse mortgages should be marketed in combination with other financial products. If you think of combining a reverse mortgage, an annuity, and long-term care insurance, that seems like the ideal package. You can keep You can keep older people in their homes while they're healthy. You can give them adequate income regardless of how long they live, and you can give them resources to cover health-related expenses. I think to study this optimal product design on the academic side, we need to develop this interesting recent literature on life cycle insurance models with shocks to health, mortality, house prices, and so on. All right, is this going to solve the retirement problem? I certainly think these products can help, but I want to say I don't think it's a panacea. And here are two caveats and concerns. Number one, they're only going to work if people have substantial home equity in retirement. So they're going to fail if people have extracted and already spent that home equity earlier in life using HELOCs and second mortgages. So Bob actually has a paper that I like quite a bit with Kandani and Lowe, pointing out that this sort of was going on through what he calls the ratchet mechanism during the housing boom. So this is a potential issue. And then finally, I have to, you know, the dismal science is about reminding people of, you know, how general equilibrium and adding up constraints make life tough. Okay, at the social level, if older people are consuming housing wealth, they're not leaving that housing wealth to younger people, right? So younger people are going to get smaller accidental bequests and therefore will accumulate less wealth by the time of their own retirement. So I think we should think we should think of this as possibly, you know, improving the allocation of resources within society. But if this housing wealth is being consumed, then that's taking it away from somebody else who might otherwise use it to save for retirement. So you just got to keep that that in mind. So I'll stop there. The back of my slides, there's some of those references that I included in the slide deck, if you're interested.
Thank you, John, very much. Would you mind taking questions?
Not at all. So questions and comments from the floor. Yes?
So I think that the decision that person or a household faces is far more complicated than just thinking about one specific financial product, and you briefly touched on this with the bundle of products. I think it's really difficult for, well, for a couple you have the risks of two people, but even for a single person, how exactly is life expectancy and conditional on being alive? What is the need for long-term care? And what financial products do I need? And to what firms do I need? And I need to read 50 different packages about insurance products. So I think that the complexity goes well beyond considering just one product and why people don't buy reverse mortgages. The problem is, I think that saving is easy. It's a multi-purpose vehicle, having a house or having a 401k, while deciding to invest in every single financial product requires a tremendous amount of complexity. As economists, we don't have a model of how people should do all of this. So, you know, I think that we should consider more than one product together, and I think we should take seriously that these are very costly decision-making problems, both in terms of time and resources, that I think we should take these obstacles more seriously, and maybe this goes in the direction you were saying, bundling these products together and providing more guidelines would help in terms of reducing these costs of decision-making.
Yeah, so I completely agree that the risks are, but I mean, you can't think about annuities or long-term care insurance without housing risk, and similarly, you can't, maybe for the Medicaid families, you can sort of think about reverse mortgage alone, and I do think it is the Medicaid families who are taking reverse mortgage in the near future, but you know, the demand side, I agree, is very complicated, but the supply side, I think, is an absolute horror show for a bundle of long-term care annuity reverse mortgage, which is sort of the optimal product. I mean, that's adverse selection and moral hazard on, I don't know, 4 or 5 dimensions. That's such a hard product. And then you take, you know, just institutionally how you take care of it. Maybe it's a piece of cake, but it seems complicated.
I make the following system. Everything you say are issues, but we need to decompose. You're quite right. As John mentioned, if people all leverage out and extract, that just means they saved less. Now, for any reason, if they save less, they're going to have a problem in retirement. That's not plus or minus of a reverse mortgage. And sometimes we make the mistake of too quickly bundling different problems. And we need to understand what the problem is. So if people are not saving enough, that's a problem by itself. And this will not solve it. And I said that. The second one on bequest, which you didn't spend much time on, if you work any model of bequest, the one that says you get the house, if you're not going to live in it, I mean, this is not an agrarian economy. Even in, Beijing, their children are working Shanghai, they're not moving into the house, okay? If the bequest, if you look at it, is you get the house, that's a terrible bequest function for the children. They're 39 when you're 65, they've got 2 kids, maximum expenditures, and you offer them an inheritance that says, someday, 3 months or 30 years from now, you'll get a windfall. Versus taking the reverse mortgage and giving them the money right now. I mean, if you really want to bequest it, that's a better bequest. So I think you could improve with the reverse mortgage if we had a good market. I think that the high degree of precautionary, which you alluded to, is that's a sign of a poor insurance market. We should have more long-term care and so forth. That would be better. But this would allow you to pay for it, okay? And, I think the other one, the ARMS, if the ARMS works best, as I already mentioned, the buyer doesn't care very much. They want the highest LTV. And so you can do that. You can put index in there. One of the things to think about, though, is that if that same insurance company or pension plan is doing the reverse mortgage on the equity piece in their equity portfolio, and they're getting these beautiful long-term, perfect match duration, high quality to match their liabilities, they may prefer that to the point where they'll give a price break to the consumer in return for having that. So we shouldn't think of this as like the same way we do it. I know I'm repeating, but it's very important, I think, that do it. Bundling is a great idea. One of the costs with these reverse mortgages, several states, maybe all of them, require you get a third party, like a financial advisor or something, to say they understood the contract or okay it. You put that kind of cost. Instead, we should have a standardized contract and get rid of all of that cost. So there's a lot of things that are needed to do this and make it work. But I think it's really, I guess what I'm saying, all your questions is, it's very important to decompose it into what it is that you're talking about, not that it isn't there, and address that issue rather than treat it as the whole. Oh, last thing on a name, Korea calls their reverse mortgage a home pension. And I think that's both more descriptive and everything else. So if we have to come up with a new name, you're the thought leaders, I'd say home pension isn't bad.
And if you take the first 2 letters of each, it spells hope.
Oh, well, there you go.
Very good.
We need to go on to that. Chris has been waiting very patiently. So.
Thanks a lot, and I appreciated the program. I have 2 perspectives, both as a researcher and also as somebody who runs a startup reverse mortgage lender. So I've spent a lot of time kind of thinking about some of these issues, and just a couple of quick observations that I'd love to get some comments on. The first is that there's little to no evidence that people exercise any of the complex options that are in these. I also have another paper on home maintenance, which shows the vast majority of people don't under-maintain their homes under HECMs, where we have individual level data that we can track zip codes and buy and sell properties, et cetera. And that's because people live in the home. So strategic under-maintenance is counteracted by the fact that you're living in a place, and so a bunch of what you get in your home is consumption from that property as well. So if the roof leaks, it's actually a bad place to live. So you don't want the roof to leak, and you don't want to let the roof leak. The bequest issue, if you were behaving truly strategically, you would actually use a reverse mortgage because it's more tax efficient. So the simplest thing is, if I take out a reverse mortgage, I don't have to spend depreciated assets, that I get a step up in basis on death. So from a bequest perspective, even if you don't believe Bob's comments earlier about it's better for the kids now than when they're in their 50s and you die, you can actually get tax benefits associated with it. So strategically using it would actually be better to do as a reverse mortgage in the vast majority of tax circumstances. I think the issue, and to your point, John, about the mortgage debt, interestingly, I think that's a bigger, not a smaller reason to see this grow. So if you look at people going into retirement, the average amount of mortgage debt from 1998 to 2004 in real terms roughly doubled. This is the Kennedy and Greenspan sort of, or the Greenspan and Kennedy observation. The majority of reverse mortgages today are actually used to pay off debt. And it's specifically to pay off a mortgage, which we could all think of as annuitizing because you're getting rid of a mortgage payment. And given the sort of mean LTV of people in their 60s among all homeowners is somewhere around 30%, and you then ask, how am I going to retire and make my mortgage payments? I really am going to need an 80% replacement rate in those circumstances if I have to still make my mortgage payments. So if you're at a 30% LTV, swapping that into a reverse mortgage actually makes retirement in some ways feasible. And so I think we're going to see that debt overhang actually show up likely with more, not fewer, reverse mortgages, and mostly because people don't have a lot of options. I think the last question on take-up is one that I've struggled enormously with. And I think it plays to two things. One of them, the first panel talked about, and you talked about a lot, John, in your comments, which is the complexity of the product. So it's really true, we can come up with better and better products that hedge more and more risks, et cetera, and we can sell them to a population that doesn't really even understand the basic stuff that we're doing. And we can combine it with other sorts of things, but the problem a lot of people have is that it's not a commonly used product, and they have a very hard time understanding it, and the required disclosures, as anybody knows with mortgage disclosures are bad. We typically our company sends out packets about 200 pages of required disclosures from HUD. And if any of you could look through it and understand it, I can't understand all the wording of it, let alone a consumer. And so the disclosures that are required and all the regulatory issues make it incredibly challenging for an older population. When they look at it, half or more people take it and just throw it in the trash. And they're like, I can't understand this, I'm not doing this. So I think the complexity of the product is a big thing, and the other is the trust factor, which is, it's true people don't trust financial institutions, but there aren't any mainstream financial institutions that even offer the product. So I could walk into my bank and I wouldn't find any of them. Forget about walking into Fidelity or Vanguard or BlackRock or any of the places that I go to for institutions. So there's no trust associated with any of the entities that are in the business. And so I think elderly people do understand in many cases their cognition isn't as good, or their kids do. And the combination of all of those things makes it very hard. That then makes it very expensive for people to come into the market because there's no general sale of the product. And so sales and marketing expenses are a very high share of the overall costs of people in the business. So it's a hard market. And I think essentially the comments that everybody made are really relevant to thinking about growing the market. I appreciate any comments that both those have on stage and also elsewhere.
Yeah, I think we should see if anybody, that very interesting discussion, but anybody else? Yes.
Two comments. I mean, to the extent that you're discovering that the person doing the reverse mortgage that doesn't use the complexity of the product, you have to get it out of the product, because certainly the people who are going to be on the other side of the trade, they are really betting their careers on that. The second point is that this is a product which is designed to sort of almost synthetically create something to cover the longevity risk that the a person taking out the reverse mortgage would have, which means that the other side of the trade is then short the longevity risk. And the equity is not just the home appreciation in Korea or the US, it's that appreciation minus the longevity risk. And most of the world, most investors need to be on the other side of that trade because there's more demand for longevity risk than there are natural things that provide that.
Yes.
I just have to say it's a little complicated, but with annuities, you're absolutely right. This is not an annuity. If I live an extra 3 years and the interest rate on that mortgage is 14%, I'm not sure your investors will be all that unhappy to get 14% for another 3 years. It's not an annuity. They're not getting a fixed amount of money. They're getting an interest rate for every year. Now, true, if the stuff goes underwater, they're not getting the interest rate, but then they're getting the appreciation on the house. It's just an asset. It's a little more.
If there is appreciation, I mean.
No, but any asset, it's like saying, look, there are no good and bad assets, only good and bad asset prices. Yes, some assets go down, some go up. You know, nobody can guarantee that housing prices is going up. That's why it's a risk. But you do that all the time. You've got trillions of dollars out there at risk that go up and down, whether they're stocks or bonds or REITs or anything else. So this is, in that sense, no different. If you think of it from a credit point of view, yes, because your mindset is I might lose. Imagine if your equity people at BlackRock said, gee, we might lose, therefore we're not going to invest in this. If it's a good price, a fairly priced, you're going to get a fair return for it. I mean, I'm sorry to go on, but I think you're exemplifying what I think is one of the problems, is it's being framed and taken to the wrong people to take this position, the risk position on.
But the longevity risk is
All right,
almost a systemic.
Yeah, but the longevity risk is rather minimal. Is rather minimal. In fact, if you work it out, if you write the annuity, all right, if the person lives longer, you're going to get that interest rate longer. I mean, it's not so. All I'm saying is it's not the same as doubling up on an annuity. That's all.
Okay. Yes. One more. Last question.
Yeah, I just it won't surprise those who know what I do, but I want to say a word in defense of home equity, which I think is kind of fascinating, obviously, to try to build a market off what's a Pareto improvement. I mean, it's a Pareto improvement to get the risk into the right hands, which is one of the few things that all economists can kind of stand up and cheer. The problems that, I've tried to kind of write stories about how to do this. The problems I've always found is that it does involve convincing the buyer on the other side of their interest. And I've said things like, well, so why don't I be the buyer on the other side for my kids? I would happily take equity. But I'm wondering, I mean, does it crack it by finding the right clientele, which I could never think of what the right clientele was. And I wanted to hear that exchange to see if there is, in fact, you could sell like hotcakes, that idea. I just don't know. If you walk around and you say this is equity, it's fantastic, it diversifies, do people say, at last, you found the key? I just...
If I can take a quick crack at that, I was ready to invest in the equity tranche after that talk to diversify a little, but a home equity bank in Canada has a horrible product, which is it's a 5-year product, an ARM, and every 5 years the bank gets to reset the interest rate, and they won't commit at all. I shouldn't say it's a horrible product, but they won't commit at all to what the rate's going to be when you renew your reverse mortgage in 5 years, because they're funded on 5-year CDs, which is the only way they can get funded. So, I mean, it may be they're not talking to the right people, or they need the right person to do the selling, but there seems to not be interest among people who take the equity slice.
All right, thank you very much.
Thank you very much.
We have lunch. If everybody could move somewhat quickly, it's to the room on the left.